Hello, everyone, and welcome back to Options Trading 101 with Steve Gans. This is part of a multi part series that I've put together to help beginning options traders understand a lot of the terms and concepts that go into options trading. So, today we're going to start on the Greeks and specifically on Delta. But let's get into exactly what the Greeks are and what that means. I'm going to go ahead and get my smiling face out of the way there. So, what are option Greeks? Well, Greeks are an option trader's instrument cluster, much like a pilot has an instrument cluster that will show things like altitude, wind direction, travel speed, all of those things that help them know how to exactly keep that plane safely in the air. The option Greeks are much the same thing for an options trader. They help you understand and model how variations in things like stock price, volatility, days to expiration, etc., are going to impact your position. The Greeks are determined by a number of different formulas that can be used, things such as the Black-Scholes model, the binomial model, trinomial model, and a number of others. Many options platforms will allow you to go back and forth and select between the ones that you might be interested in using. Now, the Black-Scholes and the binomial model are the ones that are most commonly used. Many Greeks also vary with the size of your position. It's important to keep that in mind, specifically if you happen to be following another person's trade and they say something like, I'm going to adjust this if it gets to a certain delta or something along those lines, because if you have on a one lot and they have on a three lot, those are going to be two totally different numbers. So it's important to recognize and understand that. So let's talk specifically about delta, which is one of the most important Greeks. Delta measures the rate of change of the option's price with respect to the changes in the underlying asset's price. Now, I know that sounds like Greek, pun intended, but I'm going to show you some examples here that will hopefully drive that home in a moment. I personally like to think of the D in delta as equaling direction. So delta kind of measures when the underlying stock goes up or down, how is that going to impact the value of my option? Deltas will range from a -1 to a +1, with call options being positive delta, and they're going to range from 0 to a +1. Put options are negative delta, they're going to range from 0 to a -1. And for simplicity's sake, if something has a delta of a positive 0.30, for example, we simply call it a 30 delta. We don't go in and say it's a 0.30 delta. So some people get confused on that aspect as well. And it's important to remember that positive delta is bullish, negative delta is bearish. So let's talk a little more about call deltas and look at some examples. So in this particular case, I'm looking at a long call, and I'm looking at a long call in Apple, and we can see that this long call has a positive delta of 43.2. Now, if I put up a short call, if I go and sell a call, you'll notice that now I have negative delta. Now, I want you to notice here that this long call is positive delta. It makes money when the market goes up. This short call is negative delta. It makes money when the market goes down. So delta often is interpreted also as the probability. It's kind of a quick, fast pseudo number for the probability that an option will expire in the money. For example, if the call option were to have a delta of 0.60 or a delta of 60, that suggests that there's approximately a 60% chance that the option will be in the money at expiration. So again, that's not a hard and fast rule, but it is an approximation that many options traders will use to kind of help determine whether or not that position might be in or out of the money at expiration. Now let's look specifically at put deltas. Going back to Apple, in this particular case, I am long a put. That has negative delta. That is a bearish position. I make money when that goes down. A short put that I sell, so in other words, I've sold a put here, is going to have positive delta. That is a bullish position that will make money when the market goes up. And again, in this particular case, a put option with a delta of a negative 40 indicates a 40% probability of being in the money at expiration. So what are some of the things that might change delta values? Well, the underlying asset price is probably the biggest one. If a position has a positive 30 delta, as the underlying goes up or down by $1, the option position will go up or down by 30 cents. Implied volatility will change delta values. The days to expiration will change delta values. Gamma, which is the fourth Greek we're going to look at in this series, will also change delta values. So what are some of the trade-offs with delta if I'm looking to get out there and make a trade and I propose a trade and I see what the delta is? Well, it's important to understand that if I am making higher delta options trades, particularly if I'm selling higher delta options, it's going to bring in more premium, but it also has a higher risk of being in the money at expiration. In other words, that would be a loss for me. So a 90 delta position, I'm going to bring in a lot of money if I sell that, but again, I got a 90% chance of that being in the money at the end, so it's a low probability trade. It's all about finding the balance in the trade that's right for you and your trading style. So selling lower delta options will bring in less premium, but also a lower risk of being in the money at the end of the trade at expiration. So adjusting deltas and delta hedging. So delta hedging is often used to offset risk. The hedging can be done in a variety of ways, and the hedging can be done on a position by position basis or an overall portfolio basis. Now, this whole process of delta hedging is a little bit of a more advanced topic, and we will get into that further down the road as we get into multi-leg positions in future sessions. So I do want to do a quick lab session here just to show how delta hedging works. So if I'm looking at Apple long stock here, I've got 100 shares of long stock. We can see that's at 100 delta. Let me actually open up OptionStrat here, which is great at illustrating this. So here I am. Let me show my deltas. So I'm 100 delta. I've got 100 long shares of stock. So in this scenario, as we go up a buck or down a buck, my position is going to change in value by $100. It's just straight stock. That's what stock does. Now, let's just say, for example, for whatever reason and whatever underlying this is, that I think I might be getting to a position where this thing might not be going up anymore as rapidly. And I want to hedge this position a little bit. I don't want to be 100 delta in case this thing does pull back. Well, what could I do about that? What are some ways that I could hedge it? The most common way that people do this is they will sell a call. They'll pick some point to sell a call at. Now, Apple's trading at 248. So if I sell this 250 call, we can see that this 250 call has a 0.47 negative delta. So that's pretty much an at the money sort of delta. It cut our delta risk by 52, or excuse me, by 48 basically, and dropped it from 100 to 52. So what that means is now if the underlying stock drops in value, rather than losing $100 per point in up or down that Apple moves, I'm only going to lose $52. Now, maybe I want to carry this a step further. Maybe rather than just one short call, maybe I want two short calls. Okay, look what that does to this position. That essentially puts this position in an area where it has very little positive delta now. So let me take this, we're seeing it at expiration here. Let me take it back to today. We can see now that this entire T0 curve, if you want to call it that, is very flat. Our deltas, this is called our deltas now, are flat. We can see this white line here. That's where we started. If we had no options in place here, if I were to back those out and exclude those, we can see that our delta now is 100. For every point that Apple goes up or down, we're losing $100. By selling those two calls, bring those back into play here, I have flattened my deltas to where now a move down is only going to impact my position by $4.75. So this is one of the huge uses of options in my mind, is to be able to, when I think the market is overheated, maybe I don't want to sell out of long stock positions for tax reasons or whatever else, but I want to hit the pause button. I don't want my stock positions to be fully exposed to a pullback in the market. I can come in and sell these covered calls and flatten my deltas in the process. Now, I could do that as I did here with an individual stock, or let's just say I have an entire portfolio of a stock, and maybe that represents $100,000. I could come in and just sell calls on a big index or an ETF like SPY, and I could do that and just hedge that overall portfolio a little bit if I wanted. Now, I showed here how I can do this hedge selling calls. Let me just remove that now. So another thing I could do is I could also come in and I could buy puts. And I could buy puts at different points. And depending on where I buy that put, we can see that my deltas change here as well. So I can move my puts around, and that also will change my delta picture. So that's another way of delta hedging, if you will. So that should give you a pretty good sense of how you can potentially use options to hedge an overall position. Now, the next Greek we're going to get into is theta. Those of us that are options sellers, that's where we tend to make our money, is with theta decay. So I'll look forward to seeing you all in that next part. Take care.